Hello everyone and welcome back to the sessions on strategic financial management. Friends, in this class of CA Final SFM, we are going to start with this topic, mutual funds. Now, you know one thing about mutual funds. In televisions, you would have been observing ads, and at end of every ad, you would find a statement given: mutual fund investments are subject to market risk. Please read the offer document carefully before making the investments. In Hindi, you would be finding ads coming up as mutual funds sahi hai. Now, what exactly is a mutual fund? Let us first understand that. So, let me not directly define what is mutual fund. Let me give you a different kind of background about why a mutual fund comes into existence. Now friends, some investor has knowledge of making investments in stock market, in debt market, and therefore such investor can plan out his or her investment easily. So for making investments, you should have awareness about how does stock market work, how does a debt market operate, how investments are made, how online transactions of buying and selling securities are done through the broker. So friends, first thing that an investor who is willing to invest in stock market or bond market, what that investor needs to know. Number one, skill about analyzing an investment, skill about analyzing a security, what we call as security analysis. Second prerequisite is the investor should be aware of the operations of these financial markets, in particularly stock market and bond market, which may not be the case with everyone. So just imagine an investor who wants to invest his or her money but has no market knowledge, has no knowledge about the market, would obviously need some aid, correct? Would need some help, would need some advisory, would need some information, support, would need some guidance on how to make investments in markets. So you may appoint an expert in this regard. So that expert will make all investments for you on your behalf. But these experts could be highly paid professionals. And what can happen? You have to make a small investment, and through that small investment, whatever small income you earn cannot be used to pay off that professional for his or her services. It is not simply affordable. So here comes concept of asset management. Now there are companies known as AMCs, asset management companies. These asset management companies, they come up to provide a service to such investors. So just imagine an asset management company has been formed and it is coming up with a promotion to all the investors. It is inviting all the investors. Okay, investors, you come to us, you give us all your money that you want to invest, you give us the criteria. So you give your money to us, we will manage your money on your behalf. What you just need to inform us is what is your investment criteria, by when you want your money back, in what pattern you want your money back. Is it that you are accumulating some investments, you are making some investments for getting a lump sum amount at a later stage, or you want a regular income and that is why you are making investment? What is the purpose of your investment? How should you structure your returns? And more importantly, how much risk you are willing to take, and other criterias. Once the investor is informing all these criterias to this asset management company, the asset management company promises to manage the investor's money on behalf of the investor. Obviously, a certain amount of fees will be charged. Now, this asset management company will be having a team of maybe 200 experts working towards this fund management or asset management work. But the fees of these 200 professionals, not a single person has to bear on own. In other words, a single investor will not take this much of load. That load is divided among thousands and thousands of investors. So these all investors gather up and they invest their money in a created fund. So this asset management company, depending upon the needs of the investors, depending upon the requirements of the investors, will create multiple types of funds. Fund A, Fund B, Fund C. It can name the funds based on the nature of the fund. Now, if there are multiple funds, first of all, the fees of these experts working for that asset management company will be distributed over these funds. And in each fund, there are thousands and thousands of investors who are going to commonly bear the cost of managing that fund. And that is what we call as a mutual fund. So friends, in your FSCM paper, that is Financial Services and Capital Market paper, you have mutual fund chapter even there, but there the objective of learning that chapter is from the legal background. That is, what are SEBI guidelines with respect to mutual funds, and the legal operations of a mutual fund is focused over there. But what you are learning now will become the base for learning that chapter over there in that subject. So friends, let us now talk about what exactly is a mutual fund. So this asset management company, suppose it has created a fund which is having an initial value of say rupees 1 crore. This rupees 1 crore value will be say divided into 10 lakh units of rupees 10 each. If 10 lakh units of rupees 10 each, what will happen? An investor can simply buy 1 unit by investing 10 rupees and participate in that fund. So there may be multiple investors who will be buying number of units as per their convenience, as per their requirement of investment. This asset management company will gather this money, and this cluster, this fund what is gathered is what is known as a mutual fund. Now this mutual fund, which is having an initial collection of rupees 1 crore, will be invested by asset management company into stock market and debt market. It will have a very planned structure of creating a portfolio. So this mutual fund actually reacts or actually behaves like a portfolio. So that portfolio can have stocks and debt instruments, it can have some money market instruments, it can have some liquid funds, it can have some derivative instruments also to make good money. So friends, this is all what we talk about as a mutual fund. Now how this mutual fund will grow? With this 1 crore of money initially collected, this asset management company has created a portfolio. Obviously, because the money is invested into stock market, debt market, money market, from everywhere the returns will be accumulated and there will be gains and losses also. But the management of the fund, if it is made efficiently, the fund manager will ensure that the fund does not suffer with losses, but in fact gives you gain and gain. Out of the total returns that is generated by the fund, the asset management company will deduct its own charges for managing that fund, and the balance will be given to the unit holders, the investors, in the form of returns. The returns by a mutual fund can be in multiple ways: distribution on account of dividends, distribution on account of capital gains, the growth in the NAV, what is NAV? I'll tell you exactly in some time. The growth in NAV, bonus, and maybe dividend reinvestments. So what happens? This initial amount that is invested will start growing, and that is how an investor starts generating return on their investments. So friends, in a mutual fund, analyzing what is the way in which you determine the rate of return for the investor is the most important aspect. So this chapter, if you understand from the viewpoint of an investor, not from the viewpoint of the asset management company, but from the viewpoint of investor, how can an investor determine his or her rate of return could be a very, very important objective. And for that purpose, you need to understand what is NAV. In a mutual fund, NAV stands for net asset value. In general, in finance, we understand net assets as asset minus liability. So as I have mentioned, the fund, when created by this asset management company, that fund will be invested in various types of stocks and debt instruments and in money market instruments. All these investments are identified as assets. Any kind of outstanding expenses or any type of payable arising on that fund will be the liability of that particular fund. So fund assets minus fund liabilities will give you the net asset value of that fund, and that net asset value, when expressed in terms of each unit of that fund, it will be NAV, net asset value expressed in per unit basis. So the way in stock market we have P1 and P0 as prices of the share, in mutual funds you will be finding NAV1 and NAV as the price of that particular unit of mutual fund. NAV as on a particular date will be the net asset value of that particular mutual fund for each unit of the same. So friends, what we should first do is, we should understand how to determine rate of return for an individual investor. And once you learn how to determine the rate of return, we start solving questions, and then we will later on introduce different varieties of questions, and even we will take the viewpoint of the asset management company, as in how does asset management company determine the net asset value. Because if you see, net asset value is not determined by the investor. Investor will just determine what rate of return he or she has earned. NAV is declared by the asset management company itself, but it has to follow certain types of norms for valuation. So what are those valuation norms and how to apply that and how to determine that net asset value from the viewpoint of asset management company will come at later stage. Different types of funds, open-ended fund, closed-ended fund, then different types of plans, dynamic plan, growth plan, dividend reinvestment plan, bonus plan. I will be introducing all these concepts stage by stage as and when we move ahead in the chapter. But right now, let us stick to the initial objective of determining the rate of return. So friends, with the objective of determining rate of return for the investor, let us first go back to the background of share valuation. And I'm sure the formula that you are finding on screen, you have learned this formula in share valuation. P0 equals to D1 plus P1 upon 1 plus KE. So D1 and P1 are the cash flows by end of the year, and this KE is the expected rate of return by shareholder, and when the future cash flows divided by 1 plus expected rate of return, you arrive at the present value of the share. So we have learned this formula in share valuation already. So what happens when you cross multiply, 1 plus KE will be D1 plus P1 divided by P0, and then to determine KE, what you would do is D1 plus P1 upon P0 minus 1. So you might be wondering why I am discussing this again for computing rate of return in a mutual fund. It is discussed again because this mutual fund rate of return follows the same logic of the rate of return that you find in stock market. So what you would do is, this minus 1, if you would want to include within the term, you would rewrite it as KE equals to D1 plus P1 minus P0 divided by P0. And rate of return in case of mutual fund is determined as NAV1 minus NAV0 plus I1 plus G1 whole upon NAV0. So what I would simply explain over here is, this D1 what you are finding over here is basically the expected dividend that is receivable by end of the year. So in case of mutual fund, that same expected dividend can be identified as I1 and G1. I1 and G1 both are different. I'll explain you little later what is I1 and what is G1. But I1 and G1 both represents the cash distribution of dividend by end of the year. This term P1 minus P0 is just as NAV1 minus NAV0. So what was P1? It was the expected market price of the share by end of the year. What was P0? The current market price. Exactly that way, NAV0 is the NAV of the mutual fund unit at the beginning of the year, and NAV1 is the value of the unit by end of the year. So gap between NAV1 and NAV0 will indicate the growth in the value of that unit, and this whole thing was to be divided by P0. So here we have NAV0. So friends, exactly the way you have learnt the calculation of rate of return in share valuation, mutual fund rate of return is also determined using the same logic. If you are interested to write down this whole thing, I am giving you some time. If you are not interested to write this, you can skip this next 2 minutes. Alright friends, you would have finished writing this whole thing. So earlier I was talking about what is this I1 and G1. I will explain you in details. So let us first understand those two terms I1 and G1. First of all, both of these represent the cash dividend received by the investor by end of the year. But why are we splitting that into two separate values, I1 and G1? The investor would want to know how much cash dividend he or she is receiving for the investment made in the form of dividend income and in the form of capital gain. So what exactly it is, I'll show you. See, mutual fund company has invested the money of these investors into stocks and debt instruments, into even money market instruments. From all these investments, the asset management company or the mutual fund company will receive interest, will receive dividends. That is the income component. Receiving that income, the income is in the cash form lying with the asset management company. If the asset management company distributes a part of that income to the investor, it will be identified as I1, that is distribution on account of income. However, the other component G1, what it is, this asset management company will manage the portfolio actively. Active management of portfolio means continuous buying and selling activity will take place in that portfolio, which may result into lots of capital gains. Definitely there may be some capital losses also, but generally with the very efficient management of that mutual fund, there will be some capital gains, and this capital gain would be realized in hand by that mutual fund company. Any distribution made out of that capital gain in the hands of the investor is a cash gain distribution to that investor, which is called G1. So to summarize this whole thing, I would say I1 and G1 are two different components. Both of these represent the cash dividend received by the investor. But if you would want to understand what exactly is I1 and G1, I would say asset management company is earning income from these investments in the form of interest and dividends. On the other side, it is also making capital gains. The distribution of income towards each unit of mutual fund is identified as I1, and distribution of that capital gain to each unit is identified as G1. So let us do one thing. Let us now talk about how to compute rate of return when the holding period is exactly 1 year and when the holding period is different than 1 year or other than 1 year. So let us discuss these two situations, and your attention on the screen please. So as we have discussed, determining rate of return can be classified into two different situations. Situation 1, when holding period is 1 year, you would write rate of return equals to NAV1 minus NAV0 plus I1 plus G1 divided by NAV0. Friends, whenever you are writing this formula in examination, you must define all the variables the way we have learnt. NAV1 and NAV0 will be the NAVs at end of the year and beginning of the year. So you can understand one thing, we have emphasized end of the year and beginning of the year because holding period is exactly 1 year. I1 and G1, we have just discussed. I1 is distribution on account of income and G1 is distribution on account of capital gains. So in exam you will write this formula, you will define all the variables, and then only you will solve the question. So quickly note down all what you find on screen and then we move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now take up the other situation. Situation 2, when holding period is other than 1 year. So we now have the same formula now for computing HPR. HPR stands for holding period return. So here the only difference is we will be calling this NAV1 and NAV0 not at NAV at the end of the year and beginning of the year. It will be end of the period and beginning of the period. Period as in the holding period. And I1 and G1 will be the distributions by end of the period. So here the time period is a period other than 1 year. So let us define all these variables. NAV1 is NAV at end of the period. NAV0 is NAV at the beginning of the period. I1 and G1 are distributions received at end of the period. So friends, quickly note down this also and then we move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now see how to determine the annualized rate of return through HPR, that is holding period return. So friends, let me explain the simple logic behind this calculation. I would say if holding period is 3 months, what will happen? The holding period return will be an effective return of just 3 months. If I want to annualize, what I would do is I will multiply 12 as in total number of months in a year, divide by number of months as holding period. So in my example, this will be 3 months. So 12 divided by 3 will convert this holding period return into annualized rate of return. So in simple words, if holding period is 3 months, this is the return for 3 months. So what will be your return for the year? It will be 12 by 3, and 12 by 3 of HPR will give you annualized rate of return. If holding period is 6 months, you will take 12 by 6. If holding period is not in months but in days, then in numerator, instead of taking 12 months, you would take 365 or sometimes even 360 days. So friends, note down this as well, and then we start solving questions.